Investor's Guide on ET now. Thanks for staying with us. Vishal joins us from his office in Mumbai. Vishal, we have a couple of questions for you. Sanjeev is with me. He's 28 years old and he works for an MNC with a monthly income of 90,000 rupees. Now, he doesn't have any investments so far. He doesn't have any liabilities either. Now, he wants to buy a term cover and he tells us he also plans to buy a home in 5 years. Now, this is his question. He says if he takes a term cover of 50 lakh rupees today, can he increase that cover by another 50 lakhs when he buys his home? Or is he going to have to buy two separate insurance policies? How will that work? What would you advise he do? Vishal.
Sanjeev, coming to the specific question you've asked, which is a 1 crore term cover at 28 better than a 50 lakh and a 50 lakh split cover over 28 and 32? I think the first one, which is a 1 crore today, is better. You do get the benefit of lower mortality charges because you are younger, and that works for you. Now, having said that, we must also appreciate that the need for insurance for you is a 1 crore today, given the fact that you don't have any other investments, and you do have income which needs to be protected. So definitely go for the 1 crore term cover right away. The other piece of suggestion we would make is start building towards a savings plan, because while the objective of a house after 5 years is great, in the interim, you can afford to save more and build towards the long-term savings nest. So whatever money you can save after the term cover insurance premium is something that should go towards a financial plan that you can build for yourself and your family right away.
Our next question comes in from Pratish Shetty. He wants to know, is there any way in which he can invest in demat gold on a monthly basis and track the units or the grams that he's purchased and sold? Doesn't want to buy a gold mutual fund right now. Vishal, obviously an ETF might be one of those answers. How would you recommend he goes about it?
Okay, so if you do not want to buy gold from a mutual fund scheme, then there are alternatives. The first one I would suggest is buying gold through an ETF, which is an exchange traded fund. To do that, you will need to open a broking account and a demat account. And then you can go online, or you can go and buy this through a broker or a dealer. The second one is the more popular one, which is buying gold physically. Now that you can do either through a reputed jeweler or a bank branch. Many banks do retail gold in the form of coins or bars, and you can do that. When you're buying in physical, be sure to look at certification for purity. And of course, you will have to deal with the cost of transportation and custody, etc. So these are the three options. Having said this, if you are looking at buying gold, do consider funds because they do have some advantages. And buying gold in non-physical format has its benefit that you don't have to be specific about a minimum quantum that you have to buy. You can buy in small lots and build up over time.
Our next question comes in from Mr. Siddharaj Puttaswamy. He's going to retire next year with a lump sum of 40 lakh rupees as a pension. Now, he wants to know where he can invest that 40 lakh rupees to generate a monthly income of 30,000 rupees. Vishal.
Mr. Puttaswamy, the 40 lakh lump sum that you're getting could be invested into a plan that generates about 30,000 rupees of fixed income over a long period of time. The way to do this would be take advantage of the high interest rates right now and lock in those interest rates for a long period of time. What one could do is take about 35 lakhs out of the 40 and invest into a long-term fixed deposit or any other safe bond or debenture which is offering more than 10%. At that rate, you are assured of a 30,000 rupee monthly income. And the balance money could be invested into a portfolio of stocks. And the reason we would recommend that is because over a long period of time, inflation will catch up and your need for the 30,000 rupees today will go up. So about 5 to 6 lakhs or roughly about 10 to 15% of your savings or the lump sum that you have should go towards an asset that will give you growth over time, not just fixed income. Another way to do this would be a monthly income plan of a mutual fund. The downside there would be that the amount per month that you need, which is 30,000, will not be fixed. It may be variable a bit, but the upside is that it is very convenient. It is reasonably tax efficient as well, so that could be an alternative.
All right, Vishal, thank you so much for joining us on Investors Guide and answering our questions. Remember, if you have questions for Dhirendra or Vishal or any of our other experts, you can write to us on the email ID at the bottom of your screen. You can also catch this episode on our Facebook page as well. Thanks for watching Investors Guide this week. Tune in next week and catch the show.